All right, let's talk about something that is on just about everyone's mind right now. You turn on the TV, you scroll through your phone, and all you see are headlines about global tensions, shaky economies, and you see the markets reacting. But what if I told you that reaction, that drop, was actually an opportunity in disguise? Let's get into it.
And yeah, while for most people that sentence causes immediate anxiety, there's a whole other group of investors who see things completely differently. They're actually kind of excited. Now, before we go any further, just a quick but really important heads up. This is all for educational purposes. It is not financial advice, so please, always do your own homework.
And this right here, this is the whole game. It's the split in thinking. For the vast majority of people, falling prices mean panic. But for a select few, it's basically a big discount sale on some of the world's best assets. With everything going on in the world right now making the market so unpredictable, understanding this difference is more critical than ever. So we're going to break down exactly how you can use these market drops to your advantage.
To really get a feel for this, let's put you in the driver's seat. Let's imagine you're just a regular person, trying to do the right thing by investing for your future. So you've done it. You've put $1,000 into the stock market. You picked what you think is a solid investment, and you're feeling pretty good about it. You're in it for the long haul.
And then one morning, you grab your phone, you open your investment app, and your screen is just a sea of red. That $1,000 is now sitting at $900. And that feeling? It's a gut punch. Your immediate instinct, your brain's screaming at you, is to sell. Get out now, before it gets worse.
But here's where the script flips. Experienced investors, they see that same red screen, and they don't see a disaster. They see a discount. Let's look at why their reaction is the total opposite.
Think about it. When markets take a nosedive because of something happening in the world, it's usually driven by one thing: fear. It's not because every single major company on the planet suddenly became 10% less valuable overnight. It's because human emotion, fear, takes over. But history shows us time and time again that solid markets eventually bounce back.
So how do you actually use this fear to your advantage? Well, it all boils down to a pretty simple but incredibly powerful idea called averaging down. Let's break it down with some easy numbers.
Okay, so let's go back to our example. You take your first $1,000 and you buy shares at $100 each. Simple math, right? That gets you exactly 10 shares. You're in the game.
And boom, the market dips 10%. That same share you bought is now only $90. Your first investment is technically worth less. And this is the moment most people freeze up, or worse, sell. But for a smart investor, this is where the opportunity really begins.
Instead of hitting the panic button, you do the opposite. You invest another $1,000. But check this out. At that cheaper price of $90 a share, your money buys more. You get roughly 11 new shares. So now you own a total of about 21 shares.
And here is where the magic happens. Because you bought shares at two different prices, one high, one low, your average cost for each share isn't $100 anymore. It's now dropped to about $95. You've literally lowered your own cost basis.
Okay, so let's see how this pays off. Imagine the market recovers and that share price climbs to $110. The person who just held on and did nothing, they made $100 in profit. Not bad. But you, the person who bought the dip, you're looking at a profit of around $310. You made way more money simply because you were brave when others were fearful.
And this is where it gets really powerful. Let's say the market has a really bad month and drops 30%. If you just sit on your hands, the market has to climb back up 43% just for you to break even. But if you bought the dip, you've lowered your average cost so much that maybe you only need a 25% recovery to be in the green. You've given yourself a massive head start on the road to recovery.
Okay, this all sounds incredible, right? But, and this is a really, really big but, there is a huge warning that comes with this. This strategy absolutely does not work on just anything. You have to know the difference.
This only works if you are buying quality assets. We are talking about strong, established companies or broad market indexes that represent the whole economy. Things with a long history of bouncing back. If a company is actually failing for fundamental reasons, buying more on the way down is like trying to catch a falling knife. The underlying value has to be there.
So you might be thinking, okay, that makes sense, but how am I supposed to know which companies are quality and which aren't? I'm not a Wall Street expert. And that's a fair question. Luckily, there's a much safer way to do this.
And this is why so many people, beginners and pros alike, love exchange-traded funds, or ETFs. Think of an ETF that tracks something like the S&P 500.
It's like buying a tiny piece of the 500 biggest companies in the US all at once. It automatically spreads your risk out. So when you buy the dip on an ETF, you're not just betting on one company to survive, you're betting on the entire US economy to recover. And over the long term, that's historically been a very, very good bet.
So the next time you open that app and you're staring at a screen full of red numbers, here's the question you have to ask yourself. Are you seeing losses that make you want to run for the hills, or are you seeing a temporary discount, a chance to buy quality assets for less than they were worth yesterday?
And that's really what this all comes down to. It's not just about the math. It's about psychology. It's about having the guts to act when everyone else is frozen in fear. During these downturns, a massive amount of wealth changes hands. It moves from the impatient to the patient. So remember, the biggest mistake most people make isn't buying at the absolute perfect bottom. It's being too scared to do anything at all.